and welcome to this edition of the Capital Stewards Podcast. In today's episode, we're going to talk about all things Roth conversions. Why should you consider a Roth conversion? How is it helpful? When would a Roth conversion maybe be a mistake or actually increase your taxes over time? And what are the things you need to look out for? What are those pitfalls and sort of unknown things that are out there that might catch you unexpectedly down the road? So in this episode, we'll talk about all things Roth conversions, how they can be beneficial for you. If you don't know what a Roth conversion is, a Roth conversion is just a financial strategy that involves transferring funds from your traditional IRA, your retirement account, or a 401k into a Roth IRA. And that process requires you to pay your income taxes on the amount that you're converting at the time of the conversion, because you didn't pay income taxes on that money when you put it into your IRA or 401k. You got a tax deduction when you made those contributions. So now you got to pay income taxes on the money. But the primary appeal of a Roth conversion is that once those funds are inside that Roth, they can grow tax-free, and then the withdrawals that you take in retirement are also tax-free. So you're paying taxes today in exchange for tax-free growth and withdrawals down the road, and that can be particularly advantageous if you expect to be in a higher tax bracket in the future. So that's what Roth conversions are in short. Now we're going to dive into some of the more complicated scenarios and why you should think about them and how they can be helpful in your financial planning situation. So why should you consider a Roth conversion? The primary reason you consider a Roth conversion is to save taxes. Probably not surprising. And I like to say this a lot, but taxes are a long-term game. They're not a short-term game. It's not an annual hunt for deductions. The best tax saving strategies are things that you develop over long periods of time. So if you expect your income to be lower now, your taxable income to be lower now than it will be later in retirement, it might be an opportune time to do a Roth conversion while you pay taxes at a lower rate. So let's look at a couple of charts I think that will be helpful in illustrating how all of this works. So the first chart here is a tax planning analysis. And implicit in all of this, by the way, is that you have to do tax planning. A lot of folks will come and they'll talk to me. They'll say, hey, Brian, I think I need to do a Roth conversion. And I'll say, okay, well, what's your tax rate now? What do you think that is? And what do you think it's going to be in the future? And they kind of look at me like, I don't know. You've got to have a really good idea of what your marginal tax rate is now and what it might be in the future. You don't know necessarily what it's going to be, but you can have a pretty good idea with some good planning to figure out if a Roth conversion is actually going to save you money on your taxes. So you can see on this chart, these long lines, the neon green line, the blue line, the orange line, purple line, those are the different tax brackets going through this particular person's retirement scenario. And you can see that what happens over time, especially when they get in their 70s, is their retirement income increases, their taxable income increases, primarily because there's required minimum distributions. The government says, hey, all that money that you put in your 401k or in your IRA that you pay taxes on, you got to start taking that money out when you're in your 70s. And we're going to tell you how much you have to take out every year and pay taxes on that money, regardless of whether you actually need those funds or not. So you can see that taxable income goes way up later in life. And so the idea behind doing planning is to understand, okay, we're in a tax bracket now. Right now, maybe we're in the 22% tax bracket or the 24% tax bracket, but later we're going to be in the 35% tax bracket, maybe even the 37% tax bracket some years. And so if we can do a Roth conversion now and pay taxes on those dollars in the 20s instead of paying taxes, a tax rate in the 30s, probably going to save some money over the course of our life. So all of this starts with tax planning analysis and having a good idea of what your sources of income are now, what they're going to be in the future, and then what your marginal tax rates could be. And then this second chart sort of illustrates how a Roth conversion works. So what we're going to do typically in a Roth conversion is we're going to convert money from an IRA or from a 401k over time. Generally, we're not doing this in 1 year or 2 years. People think of conversions as like a one-time event that happens. That's rarely the way that it actually makes the most sense. Usually, we look at where you are from a tax standpoint and say, hey, we want to use up all of the current tax bracket that you're already in, but we don't want to jump into the next one. And we want to do that this year, next year, for 3, 4, 5, or 6 years to get as much money out of those IRAs and 401ks as we can. And so you see what happens is your taxes go up in the near term. You can see on this chart, taxes go up while we're doing the conversions, in this case in the 2030s and early 2040s. But then there are big tax savings down the road because the taxable income doesn't go up as much as it would have had we not done the conversion. So you're paying more in taxes now to save taxes down the road. And so we've got to have a good understanding of what your tax rates are, because if your tax rates are not actually lower in retirement, and there are scenarios where that's the case, then a Roth conversion is not actually going to be all that helpful. So the potential for tax savings, that is the number one reason why you should think about doing a Roth conversion. Obviously, when you put money into a Roth, you get tax-free growth, tax-free withdrawals. That's what you're looking for. It will significantly reduce your required minimum distribution. So a key function of both of those charts that I just showed you is that those required minimum distributions, they might go away if you're able to fully convert to a Roth. A lot of times you can't fully convert to a Roth, or it doesn't make sense from a tax perspective to do that, but you can significantly reduce your required minimum distributions by doing Roth conversions. There's also what I call tax diversification benefits from doing Roth conversion. And what that means is typically when we get into retirement, we actually want people to have some money in a 401k or an IRA in a traditional tax structure for saving for retirement, where we've got to pay taxes when we generate income. But we also want to have some money in a Roth account so that we don't always have to pay taxes every time we need income. You want to be able to have some of both types of money so that you can manage your retirement income as you go through retirement. If all of your money is in a tax deferred IRA or a 401k, when you get to retirement, then every single dollar you pull out of one of those accounts is going to get taxed. And that can lead to some really high tax bills. So what you want to do is have, some money that's in a Roth, some money that's in a traditional retirement account, and even some money that's just in a standard taxable brokerage account as well, so that we can optimize your tax situation over time. When should you not consider doing a Roth conversion? So obviously the first example would be if it doesn't actually save you money over the course of your lifetime. So you need to run a projection, understand what your taxes are now, and make sure that it's going to save you money, or at least you expect that it's going to save you money. And I recommend, when we work with clients, we're looking for fairly significant savings, right? If we're going to save $5,000, $10,000, there's a lot of assumptions in these kinds of models. And so we want to make sure that, there's enough there for it to be worthwhile. But sort of here are a couple of indicators, I think, that demonstrate that you probably may not want to do a Roth conversion. One is if you're in a really high tax bracket currently, and that doesn't mean you're in the 30s. It means you're in a high tax bracket currently relative to your future earnings. So a lot of folks will come talk to us and they're kind of at the peak of their careers in their late 40s or in their 50s. And, doing a Roth conversion at that particular moment probably doesn't make a lot of sense because you're already in the top tax bracket that you're going to be in. And so if we're doing a conversion, we're probably paying taxes now at the same rate that we're going to pay taxes later. So maybe there's an opportunity that happens later on the road around retirement often, where your tax bracket goes down, you're working a little bit less. Maybe that's a more opportune time for a Roth conversion. So if you think you're at your kind of peak earnings potential for your career, and you're in a really high current tax bracket, then it's probably not a good time to do a Roth conversion. The best way to do a Roth conversion is to have money to pay taxes outside of your 401k or IRA that you're doing the conversion from. So obviously the more money we put in the Roth, the better the results will be. So if you don't have any outside capital, then the results of the conversion won't be as good as they could have been if you had outside money to pay taxes. So if you don't have any outside liquidity, maybe not as good an idea. And then the last one is uncertainty of future income. So if your income goes up, goes down a lot, right? So for business owners, sometimes we know in down years, hey, this is like a good year to do a Roth conversion because my income is really low and it's probably not going to be this low again. But if you've got a lot of volatility in your income, it might be really hard to project those future tax rates. And so you might just want to stay more flexible, right? So maybe the right opportunity isn't doing a conversion, but it's making Roth contributions when you can do that, or it's doing smaller conversions so you have some of that tax diversification, but not converting the entire thing because you don't know if the conversion will work out in your favor over time. So if you've got a lot of variable income, then it gets harder to do Roth projections. Conversely, if you have a lot of pension income, or if you have a lot of guaranteed income, or if your income's really stable, then it's easier to understand if a Roth conversion is going to be beneficial and whether or not it would save you money over the course of your life. There are pitfalls and drawbacks to Roth conversions. There are some of these things are things that I think a lot of people don't necessarily think about. So the first is you got to pay taxes. There's an immediate tax liability. When you take money out of that tax deferred account, out of that IRA and 401k that you got those cool deductions for when you put the money in there, got to pay those taxes. And so you've got to be able to have liquidity to do that. Like I said, ideally, you can use the funds that you're converting to pay the taxes. You can do that, but it makes the transaction typically not as beneficial because you're having to withdraw more money and pay more taxes on the money that you're just paying taxes with. And so it's kind of becomes self-defeating. The other thing that you've got to be really cognizant of is the impact of what I call income related programs. So if you've got Social Security or if you've got Medicare premiums, if you're already on one of those programs, your tax rate is, or your Social Security taxes or your Medicare premiums can be impacted by your total earned income. So if you're already retired, then you need to be thoughtful about how having lots of income can increase those premiums. A lot of times that's not gonna, I talk to a lot of clients about IRMA and they're afraid that their Medicare premiums are going to go up. A lot of times if we're doing a Roth conversion, we're saving lots and lots of money. The extra Medicare premiums are kind of come out in the wash, and it's worth paying the extra premiums to do a Roth conversion, but it may not be. If you're right on the line, you want to make sure that you factor in increases in IRMA, increases in Medicare premiums, changes to your Social Security taxes. If you've got really, really low income, you don't want to make your Social Security taxable. So you got to be thoughtful about those kinds of things when you think about Roth conversions as well. The last thing is what I'll call the 5-year rule. And essentially the way we think about the 5-year rule is just that, once you put money into a Roth, even if you are, approaching retirement or the retirement age, it's got to stay there for 5 years in order to get the benefit of all of that tax-free growth. Otherwise, the IRS comes back and they start taxing some of that growth as if the money was in a more traditional account. So you want to be able to put the money in a Roth, and then you want it to stay there. And every year that you do a conversion, you're not starting the whole clock over, but you've got to be able to track, if I do a series of conversions over 5 or 6 years, then the first clock starts on the first year on the first year's funds, and then the clock starts over the next year on the next year's funds, in year 3, year 4, year 5. Now once you get to year 5, you might still be doing Roth conversions, and you can withdraw money from the first conversion that you did, but you got to be able to track all of that and make sure you've got really good accounting. So I think the simplest way to think about it is just make sure that you're working with somebody that understands what they're doing. And when you do a Roth conversion, know that I'm going to put the money in there and I'm going to put it in there for 5 years, and it's got to stay there for 5 years before I take it out. And if I'm doing a series of Roth conversions, make sure you have good accounting. And then lastly, market timing risks. And this can be challenging. So when we do the Roth conversion in any given year, obviously we're taking money out and we're paying taxes. So it actually makes sense to do Roth conversions when the market is down. So if we think we're in a market correction that's short term, that's not going to last, we actually want to take money out and do the Roth conversions when the market is down, as opposed to when the market is up. But if trying to time the market, just like anything else, is very challenging, and so knowing exactly when those moments are can be tough. And so you want to make sure, again, like I said, that there's enough of a benefit there to doing the conversion that even if you were a little off on the right time of year to do the Roth conversion, you still make money over the long term. So. And then the last sort of watch out, I think, for Roth conversions is just that there are lots of tax changes coming down the pipe. So there were changes to the way Roth conversions worked in the 2017 Tax Cuts and Jobs Act. I don't think they'll change a ton this year, but it's possible that the tax bill that's being debated in Congress that's going to extend the 2017 Tax Cuts and Jobs Act does impact Roth accounts or retirement accounts and the right strategies and the way those things happen. And so obviously this year you can still do Roth conversions, under the current tax structure. So maybe that means you should go ahead and consider doing something, but you want to be mindful that perhaps the rules could change at the end of this year. And what you do in 26, 27, 28, if you're thinking about a series of Roth conversions, that could change over time based on how tax law changes. So in conclusion, Roth conversions are a tax strategy. The goal is to pay taxes today to save money down the road, because we expect our tax rate to go up over time to be higher in retirement, particularly when we get into those required minimum distributions in our 70s and 80s. And that is the core reason why we do a Roth conversion, is to save money on taxes. It's a really common strategy. We talk to folks about it a lot. So if you think a Roth conversion might be beneficial for you, if it's something you think you should consider, then certainly click the link in the show notes. We'd be happy to continue the conversation with you and look at your particular situation and see if a Roth conversion is right for you.